This is a very quick introduction to TradingView platform. Obviously, those who have been following my videos have seen that I have prepared the charts in TradingView, and it is now a very well-known platform. This video is actually aimed for someone in my family. She is starting off, so I am just introducing this platform to her. For others, or for the benefit of others, I will make it public like I always do. So if we go to tradingview.com, this is the portal. One can take a paid subscription, and to start with, unpaid subscriptions are just fine. There is absolutely no need to take a paid subscription to start with. So this is I am already logged in. So then one has to create. I'm sure everybody nowadays is tech savvy enough to know how to create an account. You have to just click on register, fill up some details, and so on and so forth. So the main component here is the chart. If we go on to the chart, so this is something which I regularly monitor, which is the Nifty 50 future, but I will not get into all this. This is meant to be introductory, purely for the cash market. So in the equity market, there are stock market, there are two sections. One is the stock, known as the cash, and the other is the derivatives, known as the future. So this is only for the introduction to the cash market section. So here you click on stock, and you have to enter the name of the stock. So let us say happiest minds technology. This is just randomly the name that came to my mind. Now let me remove all this noise. So these what we see here. So here is then a time frame. It could be 1 minute. So each candle here represents the price change over the chosen time horizon. Here 1 hour, 1 each means 1 hour. So this candle represents the high, opening, closing, high and low during 1 hour, and green candles indicates starting at low and finishing high, that means profit, and red candles means starting above and finishing below, that means loss. From closing to closing basis. So we will not look at 1 hour. We will look at daily. So each candle represents the price activity throughout a day. Let me also remove all this noise. So for each day we have a candle. So I am putting the cursor on the latest green candle. Then you can see the stats above. So you can see the opening was at 1318, that is the price. Highest was 1352, the lowest was 1315, and closing was 1343. So opening was 1318 and closing was 1343. So it's showing 1.59% in jump in one day. So now today it had opened higher at 1355 but closed at 1339. So it is a slight fall. So prices move like this only. They don't go up or down in straight line. They are always doing up and down. So this is the candlestick. It tells us a summary of the price actions during the entire day. So if I am doing now, instead of day, I can also use week. Then it will tell me the summary of that week. So in this case, in this week, it has starting from 10th Jan to till now, the price so far has increased only. If we look at the previous week, what happened? It is from 3rd Jan to the week that finished last Friday. So it opened at 1308 on Monday and closed on 1298 on Friday. So in between there was of course lot of price fluctuation. So wider the length of the candle, the more the fluctuation. So the candlestick is a very effective way of representing the price action, because it not only shows the opening, closing, high and low, the body of the candle also tells us the story that how much volatility has been there. For instance, in candles like this, you see opening and closing basis, there hardly has been any change. Whereas in a candle like this, you see the length of the candle is so big, opening and closing, there has been a huge jump. So these are effective ways of visualizing the price action. So what we generally do is, initially it will be simpler just to look at the line chart. So how a line chart is made? Line chart is made by joining the closing values only with straight lines. So here we further filter out, we get rid of all noise, only closing prices are there. So it is as if like the mutual fund, it reports the NAV. So if someone is just buying at the end of the week, so you forget all other price actions throughout the day or throughout the week. So it is like on every Friday, on a weekly channel, on a weekly time frame, on a daily time frame, it is the closing value of each day. So why there are different time frames? So one can also choose a monthly time frame. So why there are different time frames? Because on a monthly basis you get the view of a wider trend. So for instance, Happiest Mind is a relatively new company. So it has data from 1st September 2020 only. So since then it shows the long term price action. So it is constantly on the up. It had peaked out around August 21. Since then it has corrected quite a bit, but it is steeply rising. And then if you go to week, then you will see the more details. So it has been ups, but there are many ups and downs, as you can see. So these are called the taking support. The price has taken support, that means made a low. So these are typical some price patterns. So one low, lower low, higher low. So this is called a reverse head and shoulder pattern. Anyway, the main point is that the price here has taken support. So these are supposedly good buying zones. One can buy at these price levels, keeping a stop loss at this. Stop loss means if the price falls below, then we exit. And from here, generally the risk reward ratio is good. So on an uptrend, this is called buying on retracement. So the price action overall trend is up, but the price has, after a sharp rally, the price has corrected. It is forming a reverse head and shoulder pattern, or the price seems to have bottomed out. So with this, so we can draw lines also here with a horizontal line. Let's draw a horizontal line. So the horizon 1239. So 1239 will work as a what we call a stop loss for us. So probably we could have bought here around. Let me draw another. So we could have probably purchased here above this price, above this price. Let's see. Yeah. So this 1239. Now the wider the time frame, the more true is the trend. So if we, what do I mean by that? If you go to, you will see lot more ups and downs. The smaller you make the time frame, you will see more details, but there will be more noise. So the reason we shifted from a candlestick to line chart is that we wanted to get rid of noise and see the overall pattern. But from the more smaller time frame you go, you will see more more ups and downs, more noise. So generally the idea is always to look at the monthly. So here the monthly trend is just up and up. There has been a consolidation. Now go to the weekly and see there, these are good buying zones. And now then there is okay, so you see on the so what one basic question: if I have considered 1239 to be my stop loss, what would have I should have done if it had fallen below this? Well, The answer is very simple. Then we should have exited at least partially. Okay, so this is one of the basic fundamental principles of trading, that have a stop loss, and when the price falls below the stop loss we sell, book the loss, and when it breaks out, that means either it crosses a previous high, or there we will discuss this later. So one of the basic principles of trading is that we sell low, and we buy high. This is highly counterintuitive. Generally we are trained to buy at cheap, and we like buying cheap, right? Now this is one behavior that is extremely dangerous in stock market. We don't buy cheap things in stock market, because something that is cheap can easily become cheaper. Okay, so just to give an example, if we look at the idea, so if we look at the, let us say, the monthly chart, so it was 110. When it would have fallen to 47, it must have looked very cheap. More than 50% correction, then it bounced back, then people must have also been very happy. Then again it made a second bottom, many people would have purchased here. But when the price started falling, people would generally tend to hold to it. But generally when this level 44, from where it started, when this was broken, smart people exited it, and see, after that crash, and now there seems to be some kind of consolidation. But again, if on the downside, if this level is taken out, if 9.35 is taken out, then it can, again there is no lower limit, a stock can always become zero, and it can even go delisted. So these kind of things are extreme, but it can happen. So we never hold to falling prices. So this is one of the basic principles. So now we can practice with more. So let's look at the stock. This is in news, TCS. So in TCS, you see the monthly chart is, it has been a consistent wealth creator over the years since 2007. If one would have just purchased, and these are different types of companies. These are like keeping in banks. I am not a stock recommendation giver, just a idea, so you see, one thing is, stock market, the growth is not linear. This is important to know. There may be a period over which the stock price may not do something, then suddenly it picks up, again consolidates, and again picks up. Now there is a tremendous tech boom post the COVID crisis. So this is monthly. Again let us look at weekly, and it is very important and healthy habit to always look at 3 time frames. So this is just a basic introduction, and one by one I will discuss more things. There are this is the price is the ultimate thing in trading, because we buy at a price and we sell at a certain price, and then comes the volume. So all the indicators in the world are made up of two things only. So the first thing is to look at a lot of charts, and in 3 time frames generally for each chart: monthly, initially it may be a bit confusing, weekly, and then daily. Just train your eyes on this. So these are kind of buying zones. So we'll talk about that, so we can see how to identify a trend, and so on and so forth. So in this way, it is important to look at many charts.